Stock started the week on a high note today, continuing a run by these large cap tech stocks that show the leadership and haven't given up that leadership, have not passed that baton yet as much as we expect that they would at some point in time, but still haven't. So, and we showed some bullish sign, some good bullish technical signs that kind of gives us an idea of that we can go up. The question is how much longer. Like on this next run, are we getting a new intermediate run, a new near-term run? So I'm going to break that down. Again, not that we expect us to pull back or tank anytime soon, but at some point in time, as we grind, as we see signs of grinding, especially as we hit that 4-month mark, which we're getting really close to by the end of this week, by next week, we'll hit the 4-month mark on this intermediate run. We're going to start to see some signs of when that breather will come. So I'm going to talk to you about what to watch for in anticipation of that, while still maintaining, following the trend. And for that matter, with our trade idea, the type of strategy that on the type of bullish stock that you can still do with a mature bullish trend that we've had. So let's go ahead and get started. Today is Monday, August the 3rd, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500. First, with the market forecast indicator coming a day after this overbought cluster that we talked about in Friday's video. We continue to grind a little bit higher today. So we actually got up to a new 4-week high point with today's small move. There was a little bit of a gap in there. We have to keep that in mind. But the near-term line getting up to its highest level since back here, when we were kind of ending this run that we had. We are getting closer and closer to 33.93. That's the highest high that we've had pre-COVID. We're only 100 points away now, less than 100 points away. The market sentiment line continues to fall. That's a function of just how slowly we are rising. On this, we had this kind of near-term pullback, and that near-term pullback was enough, combined with this weakness that we had here, to keep the market sentiment line slowly rolling over. We haven't been able to bounce up enough and fast enough and hard enough off this period of weakness to really keep it going up. But all the lines are up here, so it remains strongly bullish in that regard. You can see the Dow Jones Industrial Average bouncing back up, giving you light green or dark green shading again with a green line. A lot of stocks looking like that here today. The Nasdaq Composite giving you a new all-time high with today's move. That's a positive development for the index. It's again new 52-week highs, new all-time highs are not bearish, right? They tend to be bullish. And you can see dark green shading again with the intermediate line closely. Looks like it's on pace to get back up above its market sentiment. It's been the only index to keep it below, but with that strong near-term move, you can see there's a good chance we get back up above there, barring a big near-term collapse, of course. The Russell 2000 has been the one that's been struggling the most. It's where the Nasdaq is not just above the S&P, or the 78%, so well above the 100. The Dow's getting really close to the 78%, and the S&P is through the 78% mark of this decline. The Russell is still further away, and it's still not able to really get going. Strong momentum line today, but the near-term line not very strong, not very high, not as high as its peers. The intermediate posture is strongly bullish. That's a positive sign, but it's just not as strongly bullish as we've seen in some of these other indexes. And again, remember, this is more reflective of actual U.S. economy, Main Street type economy, and you can see it's not showing the same level of bullishness as you see, in the Nasdaq 100, which is dominated 50% roughly by the big companies, right? The big large cap tech companies, including and it's after them you have companies like Tesla and Nvidia and Netflix that also are pushing up at high levels here. But again, the big names, Facebook, Amazon, Apple, Google, Microsoft make up nearly 50% of this particular index. About 25% of the S&P, and that's why the S&P mirrors more the Nasdaq than anything else, even more than the Dow Jones does. The Dow Jones, you can see its intermediate line had fallen to the market sentiment, but only because the market sentiment line's falling. Again, same concept. We had this period of weakness here. We've been unable to really get going to the upside to kind of combat that, to show that we've bounced off of it. That's why I don't think that's enough of an intermediate low point. Obviously, it didn't get dark pink shading and a red line. It didn't even get dark pink shading on these other indexes, aside from the Russell 2000 briefly there, and then there's the Nasdaq. So not enough of a pullback here to say, oh, okay, here's enough to get going for 1 to 3 months, right? We're still on this current move here where we jumped above the 50 level, jumped above 50 on the intermediate line back in April the 9th. So again, we're less than a week away from finishing 4-month-long intermediate run here. And that intermediate line continues to really move up well inside, well above the 23% line. So again, any move down to the 23% line will be significant. Will be the beginnings of an intermediate pullback. And remember, we can go from 0 to 23 like that, just like we saw here, just like we saw in some of these others. Obviously smaller moves then because the gap wasn't so big. Now the gap is bigger because we keep moving it up, right? But the reality is you can go from 0 to 23 very quickly. There might be a little bit of a pause here at the 78 if there ever is one, of course. But there's not a whole lot of support. So if and when we do get back to the 23, and we always do, so we will at some point in time. As of right now, that would be without really pushing up higher quickly and pushing the 0 line up and bringing the 23 line up to the 30-day moving average. So barring that, then again, like I said, once we get that, then we'll know we're in for a period of time of light pink shading and dark red lines. Doesn't mean that we'll drop, all the way down. And you can see as we move this up, we're going to eventually move the 38% line up too. And it might eventually line up with the 62%, because that's kind of where I expect that we'll fall down to, is that 62% line. That 38% line might be a little bit above it, or be right on it by the time, if and when we ever do get down there. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us here on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us 2 things. Number 1, you liked our video today. And number 2, you want us to do another video tomorrow. It's a quick way to give us feedback. If you like our videos, you like us to keep doing it, let us know with 1 click. You can do that right now. If you don't like our videos, of course, you don't have to click on anything. Also, while you're down there, comment. What did you get out of our video? What questions or comments do you have about anything I talk about tonight? Join our website at marketscholars.com. There's a link popping out right there, top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter at DavidSettle42 for more content in between these videos from day to day. And join our Market Outlook Facebook group that we created. As always, if you're watching us here on our blog, we invite you to check out our Market Outlook live video. Every day I do the Market Outlook. I also do a live video at 3:30 Eastern Time where I review all of our old Market Outlook trade ideas that we're still currently in. And put on today's trade idea before the market closes. Also, you can check out all of our classes here on the calendar here on the upcoming classes. And then finally, we invite you to click on this heart that opens up this new window. Hit that like button there. Hit this thumbs up. It takes you to your Facebook account where you can click on this like button right here. Again, the more you do that, the more it benefits us, because the more these posts have likes and engagement, Twitter and Facebook will promote our content to all of our followers that follow our accounts, even if they're not on when we post. It also benefits you, because Facebook and Twitter will promote content in your timelines from the accounts that you engage with the most, even if you're not on when we post these. So we invite you to do that for us there. All right, now let's take a look at the long-term charts, and we got a really good start to the week on the Heikin-Ashi candle. So closing above the last 2 weeks' highs, higher high, obviously no lower shadow. We're not even close. The open today or this week at 32.1782. We're at 32.94, so we'd have to have a pretty significant decline. We are getting a little high now up on this up on the PPO here. So the 50-day moving average is, over 4% above the 200-day moving average, or 10 and 40 weeks. So you can see there's been times where we've been this bullish before, but those have always been, the 4 and 5 month long rallies that really ended really badly. So that we're kind of reaching the limit in terms of how far away the 50-day gets from the 200-day. That doesn't necessarily mean we have to drop down like some of these other times. We didn't drop down to the 200-day moving average, but you notice we did drop to the 50-day moving average on some of these, and even on this one over here from these levels, and some of these others we did drop to the 200-day moving average. So we are relatively high, but I think at worst, you can see that now. Well, if I move this up here, activate this drawing and move it up to now the new high point, so right here, you can see now that the 200-day moving average is actually up above the 23% retracement. So again, that's how significant this move has been, without a breather, that the 200-day moving average is above. So again, you pull back to the 23% line, and we're going to be fiddling with breaking below the 200-day moving average. All right, so and pretty significantly below the 30-day moving average, as we saw, and also well below the 50-day. So that kind of gives you an idea of what a breather is going to look like. I mean, again, 0 to 23% is not a pullback. It's just It's just noise. You don't get a pullback until you break the 38. Break the 23 and work your way down to at least a 38% or somewhere in there. And so that kind of gives you an idea of just the extent of this move and how crazy it's been. You can see the Dow, the NASDAQ with another good bullish candle here after a couple of transition candles. We're back to a really strong bullish candle. And look at the Russell 2000 finally getting a golden cross. So we got it on the Dow a few weeks ago, and now we're getting it on the Russell. Still not quite above those highs, and still, of course, not to the 78% retracement, but at least that's a positive sign that we haven't seen on the Russell for all these weeks that we had seen it, especially on the NASDAQ, where we only in a bear cross for like 2 weeks, and then on the S&P we had gotten that golden cross about 6-7 weeks ago. Let's take a look at the 3 green arrow chart, and you'll notice again, back to 3 green arrows. So the MACD is back to being positive. Stochastics, of course, is back to being positive. When you look at it on the 2-line version here, let me get rid of this. There we go. So you can see it a little bit better. So you can see on the 2-line version of the chart, we're easily trading above. We have been, couple brief little turns on this MACD pullback below the 8-day moving average. We never did get below 17. We're back above the 8, and they're all rising. Stochastics is back above, and MACD is back above its moving average. So we'll see how long this next leg. Essentially, this is the next near-term rally. The near-term line's been above 50 now for 4 days, and the typical run 7 to 12. So we'll see how much longer this, another week potentially, of how long this near-term rally will last. All right, now let's take a look at the intraday chart today, and you can see the gap up. So remember, gaps get filled. Now that has the makings of a breakaway gap here, breaking through these highs. But keep in mind that another aspect of breakaway gaps is volume. At least higher volume than what we've had, and this is actually one of the lower volume days we've had in a while. So probably not, in that case, a breakaway gap. So which means we're more than likely going to fill that in here. Now probably won't go down too far. We are above, the value area here, above 327.05. We might come back down into this spot. There's a lot of volume there, and then bounce back up. So that might happen as early as tomorrow morning or even overnight. Of course, if we do get below 327, then watch for this 321 area for us to, again, that point of control to draw you in to it when you're inside of the value area there. But no threats of any significant downside moves. Like I said, you still got about a week and a half before the low point really shifts up into this 319 spot, right around 319, and so that's about a 10-point range. That would be one of the smaller ranges we've had if we don't push up to new 4-week highs between now and then in the next, again, like I said, week and a half before we get past this low point over here. But at least we do got a new high tag, and that's good to have a high tag in that direction. Again, we haven't got one of those yet, and IWM came really, really close, but IWM's tag keeps getting really, further along, and then QQQ we did, so which is really good because again we were getting our low tag was way over here, and our high tag was way over here on the left, so that's bearish. So it's good to get the high tag back on the right hand side of the low again. More of a bullish stance there on all these indexes. So positive development again for a continued near term. I'm not looking for like a new multi-month run here. Just a good opportunity for this near term run that we're on to continue to go on for however 7-12 days on average. So again, probably not without a little bit of a filling into that gap though first, because even here, like we saw on the S&P 500, even on the QQQs, the volume came in really, really light compared to previous days. Let's take a look at the volume for the S&P, which you see was 53 million in the trading range with that gap. So we closed at 326.52. The low today was 327, so about $1 gap. So it's still well below the ATR average, and it's actually below 1%. Because remember 1% mark is a key figure here. So for this average to get down below 1%, we got to get more ranges that are below 3 points. To get the number down. So again, that's going to mean that we're going to really grind to the upside really slowly, but that would be a good sign for us to get below that 1% mark, and you can see the volume is already significant. The average volumes there are significantly lower. And then you look at the volatility index, and you can see we bounced up here, but we're still really low. And watch for the rest of this week if we don't grind down towards that 80% mark. And setting up for some type of volatility, a little pop, even if it's a short-term, near-term pullback, a pop back up to this 90% mark would just be a near-term pullback, and for us to get an intermediate pullback, we have to get up closer to this 105% mark. So like I said, I think more than likely we're going to go from 0 to 23% on the market on the Fibonacci's really quickly, which means we'll pop up really quickly. So most of the damage will be done before we know it. So after that, it'll just be a matter of staying down and maybe pushing a little bit below for the rest of the intermediate pullback that may last 3-4 weeks or so. So when will that happen? Well, it's more likely to happen the more extremely low volatility gets. So as it gets below, as it gets to this 80% mark and maybe even closes a day, if not a week, below this 80% mark, similar to again over here at the end of 2019, and you can see a little bit of even just a short-term, near-term pop in volatility we got when we got that extreme. All right, before we look at some of these other markets and our trade idea of the day, just to summarize our technical outlook, we're strongly bullish on the posture. We're mature in our posture. The near-term run looks like it's got some legs, so we got maybe another few days to a week left on this near-term run. Again, just kind of watch for signs of grinding and extremely low volatility. We'll never know when the pop will come because it will just come. It will come out of nowhere. But we can start looking for the signs of it as we get more volatility, compression, and slow moves and grinding moves and divergences that we're just not seeing quite yet. But we are mature in this trend, and we are close to 4 months. And 4 5-month long intermediate runs haven't traditionally ended very well for the S&P. So we just need to kind of be aware and be on top of that, because we're not going to be able to say, okay, now the markets are going to be bearish. So before we start selling off, make sure that I'm giving you this opportunity to close out your profits, and no, it's just going to come out of nowhere. So we have to be prepared in terms of how we manage our trades, so we're not caught one-sided chasing a really bullish, mature trend that will just turn on us and cause us to sell at losses instead of selling our profits that we might be losing. So what do you think? Do you agree with that? Do you disagree? Comment down below, especially if you disagree, whether you're more bullish than I am or more bearish. whatever you're looking at that causes you to be more bullish or bearish, share with us that chart or indicator, whatever you're watching. Share with us down below in that comment section. All right, now let's take a look at what's driving the markets here today. And let's take a look at how these different asset classes, you can see Qs, just the 3-month returns are just huge, 26% in 3 months. And the S&P is up 16% in 3 months. So we're still, now granted, once we get to this June 8th mark, this is kind of give you an idea, that's the last time, that's when we kind of peaked. And in small cap stocks had our big run up to that point, and the dollar was down, gold was down, and bonds were down. Big kind of risk off move from that point here. Since then, so it's been almost 2 months now. Since then, you can see gold is up 17.5% from that June 8th high. Bonds are up almost 10%. The Qs are up 12%. The dollar's continuing down, most of it here recently in the past couple of weeks. And then there's your S&P 500 up 3%. Small cap stocks are actually down a smidgen, just barely below 0%. So, and of course, commodities doing okay. High yield is flat, actually coming in below foreign bonds, well below treasuries. So, and then of course, like I said, gold, commodities down below gold, reflection of a weakness in crude oil in that basket of commodities. So kind of a risk-off move that again is masked, as it has been for the last few years, by strength in large cap tech stocks, specifically those big names, those big mega cap names, are really able to keep risk appetite afloat. And the other thing too that's continuing to keep risk appetite afloat is this falling U.S. dollar. The euro, granted, it's kind of hit a peak and it seems like it's slowed down, but we kind of expected it would slow down, but it's not going to change the trend. We don't expect it to change the trend. We can come down. Remember, we can go from 0 to 23 and just be noise. So, and that's about another 100 plus pips away. That shows you how much the dollar can go up, especially if we get any kind of intermediate pullback now. If we get an intermediate pullback later, then you'll see a higher high, kind of a divergent high point form, especially like on the near term line on this, and then we'll pull back down to wherever we end up with the 0% by then. Then we'll pull back down to the 23%, if not lower, to have a full retracement, which would most likely take place then during an actual intermediate pullback in risk appetite. Let's take a look here at the foreign markets and how they're doing, specifically these large economies. Let's go right here to the primary 12 grid. So China, Japan, Germany, a lot of European countries, as well as in Asia. And you can see we don't have a lot of dark green shading and green lines. India is one, Korea is one. You can see Canada is doing well, and Brazil. But the rest of these are light pink shading, and at best, in Europe, green lines. In Japan, a red line, and in China, we have dark pink shading and a yellow line. So we've really had some significant pullbacks here broadly that isn't quite reflected in this risk appetite as a whole. Again, it just kind of shows that we're losing breadth, not breadth in terms of, even though I did show, I don't know if you saw this, I retweeted this out, the chart of the day, where the NASDAQ was up at 1.5%, but had fewer than 40% of its issues that were higher on the day. So these are all the days that was the case, where we're up more than 1.5%, or in this case 1.6%, with 40%. Now you notice, that might have caused some short-term weakness there, but we still rallied coming out of that kind of 98 period. And then towards the end, we started to get more and more of these, as well as towards the bottom here. This is our first one that we've had since then, since that tech peak. And this is actually the lowest ever at 33%. So from a breadth standpoint, it wasn't very good on Friday. But then from an international standpoint, you can see we're not getting the great breadth either. We're not bearish, we're not tanking, but we're slowing down enough that we're getting, light pink shading and dark pink shading and red lines and yellow lines. So this is something to kind of keep aware on in terms of, again, how bullish we expect to be from today going forward with any new aggressive directional trades we might have. All right, now let's take a look at how the sectors performed today. And just look, again, you can see, your QQQ names continuing to lead the way higher. Let me show you really quickly before we get to how they performed today. Let me show you from that June 8th high point again, and how things have performed since then. You see technology, communication services, discretionary, and staples even up there, and that's what's lifting it up, because nothing else is positive except for barely materials, and then your utilities and real estate are up here, but industrials and financials and energy are all just struggling. Since they peaked on June 8th, they had such a run to get there. They're all down. Energy is down 20% from that June 8th peak. There's not a whole lot of stock, a lot of areas in the market that are down 20% during this rally, and this is during a significant rally at the same time that XLK, which is a lot of Apple here and Microsoft as well, is up 11.5% during the same time frame. So that financials are down 8, and industrials are down almost 4, and they're up 12. So it's really kind of showing again where the leadership in the market has been, and probably most likely still will continue to be through any kind of intermediate pullback and potentially beyond that. You would expect that these stocks will continue to lead us up until we transition out of a pandemic economy. Right now we are in a pandemic economy, and we will be in a pandemic economy for who knows how long, until we get any kind of vaccine, or until the vaccine is widely distributed and used and shown to be effective long term. Right, we'll continue to be in some type of pandemic economy, and so that favors these Qs. I mean, even through the end of the year, if not into the beginning of next year, you would expect that to be the case. All right, so you can see we got a lot of strength in consumer stocks, both discretionary and staples, and so that leads me to looking at Target. Target had a really kind of good breakout pattern today. It had its own cluster like the S&P on Friday, and then kind of broke out, not to new highs. And new highs are back here, pre-COVID highs. Actually, that well before pre-COVID. It was actually kind of at the end of the year. We had those highs. We're not quite there yet, but we're bullish. We're strongly bullish. Very strong near-term run. So we don't necessarily expect that you'll get any significant downward moves here. You can see we're bouncing off the 50-day moving average to the upside. You can see here, that we're pulling with the MACD is getting strong and moving up. It's already relatively high, but the average isn't yet, so it's got some time to move. You can see the average is getting above 80 as well in stochastics. You take a look at some of these other oscillators and decent patterns here, breaking above 60, getting above 70, and above 200 down there. You look at the DMI for Target, and you're not quite above 30 yet, so it's but we are close to crossing above 20 on the ADX, so relatively strong pattern. For at least we'll get light green shading on the DMI here probably tomorrow as that ADX crosses up above. And then you take a look at the Bollinger Bands, and you can see, okay, well, we're kind of breaking above the value area, and we've got some moves. We've got earnings coming up before August expiration. So, we've got some upside potential. You don't expect a big move to the upside on earnings. And even if we got a big move to the downside, look at that big, strong support we have down here. So that sets me up to do an iron condor trade on this. So we'll take a look at selling at the 20 deltas. So selling the 119, buying the 114. Going $5 wide because you have to on the call side. So we'll sell at the 135, buy the 140. That gives me a balanced condor. You can see what that looks like here. Only going with a couple of contracts because of the earnings, so I'm reducing my risk with a smaller position size than normal. That still gives me a pretty decent return because of that volatility. I get some pretty decent return. Even if I had a full position size, that's a pretty decent return. So, but for less than 3/4 of my normal risk, I'm getting this. And again, the idea behind that is the earnings coming up, so I'm risking less. And you can see the blue lines are where my break evens are. So that good volume node will be helping me stay positive on the downside. And then if we do go up, we've got room to go up. That's the nice thing about condors. They give you more room to go up than, say, a bear call spread, which you wouldn't even want to do by itself on a stock like this. But because I can do a short put spread and a bear call spread, I can put them out wide and just let the stock grind, as we expect kind of the market to do. And even, even through its earnings, you would expect, even if we had some kind of knee-jerk reaction, wouldn't last very long on a stock that's just slowly moving here, especially over the last few months. Alright, so that does it for today. As always, you've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen to go to our forums, our Market Outlook forums at marketscholars.com. Open up any new thread there with any questions or comments. Reply to anybody else's threads as well. Let's keep this conversation going between videos. As always, thank you very much for watching. Subscribe to our YouTube channel. Hit that thumbs up icon. Comment on our video. Follow me on Twitter for more content. Join our site as well as our Facebook group that we have. Have a great rest of your Monday night, everybody, and we'll see you all next time.